Hi folks, Adam Taggart from Peak Prosperity here. I just want to give you a little bit of context on the webinar you're about to watch. You may be familiar with David Stockman. He was the youngest cabinet member of the 20th century. He was Ronald Reagan's head of Office for Management and Budget. He then went on to become a U.S. congressman and then work for BlackRock in the private equity sphere. Basically, David is an insider's insider. He knows the people and the infrastructure, both on the government side and on the Wall Street side. So he understands how the game is played and who is playing it. Anyways, David came to us because he's so concerned about where things stand right now that he wanted to have us help him produce a webinar for his audience over at contracorner.com, which is the website that David runs, and basically help him explain the key risks that he sees going on right now, why he's so worried, and wanted us to come along and help him really educate his audience on what folks can do today to avoid becoming collateral damage when the next major market crash comes along, because David thinks that the probability of that is exceptionally high right now. So that's what you're going to see here. David talks for a bit, gets in conversation with Chris on some of the macro risks they see. And then we as Peak Prosperity bring on to the webinar New Harbor Financial, which is the financial advisor that we endorse, and have a little Q&A with them and let the audience get going with their own Q&A. So enjoy what you'll watch here. Welcome to the Investing in Today's Dangerous Markets webinar. We've had a ripping rally in the stock market since January 1st. We had a little bit of market weakness at the end of 2018 that's quickly been reversed as 2019 started. The central planners have been pulling out all the stops to try to keep the everything bubble alive. They've had continued massive liquidity. They've had 180-degree policy changes at the major central banks, including the Federal Reserve. They've been jawboning this market day after day after day. Definitely touting as much hopium as they can come up with. The core central premise of that has been the trade deal with China. That was imminent. All of a sudden, we're beginning to see that wasn't necessarily the case. And with the trade deal failure that's we're seeing here in the news recently, the markets have really become very wobbly, and now the entire house of cards threatens to collapse. So David and Chris are here to discuss the biggest risks that they see in today's markets, what they're watching most closely, and they want to make sure that you can take prudent steps today to avoid, again, becoming collateral damage when these markets end up collapsing or at least correcting majorly, as it looks like they are just empirically going to have to do. So David and Chris, I'm going to hand it over to Chris for a little bit of context setting, and then we're going to get he and David in dialogue for about 20-30 minutes or so. And then we're going to bring on New Harbor Financial, which is the financial advisory firm that Peak Prosperity endorses. We have a lot of people who read our material and say, hey, I really appreciate the way you guys see the world. I can't talk about these kind of things with my financial advisor. He doesn't see the world the same way that I do. How can I put a portfolio together that takes these risks into account? We have found a firm that we've been working with for the better part of a decade now that takes David's material, takes our material into consideration when they're putting their portfolio strategies together. And David has very kindly asked them to make them available to you today on this webinar to be able to ask whatever questions you want of a firm like that. Chris and I and David are I think, united in our opinion that this is a time for taking action before the markets collapse, and you want to work with a professional that understands these risks. So we're providing access to you today through this webinar for that. One thing to underscore before I hand it to Chris is what you hear today is not personal financial advice. I think that's probably intuitive and obvious to most people, but this is for educational purposes only, and you absolutely should be talking this through. Any steps you want to take through with a professional who again sees the risks that we're talking about here. Again, you get a chance to talk to New Harbor, and we'll provide a link where if you want to actually set up a personal consultation with them for free, you'll be able to do that as well. But whether you work with New Harbor or somebody else, again, we want to underscore that this is for educational purposes to be reviewed with a professional financial advisor. With that said, Chris, let me hand the baton over to you.
All right. Thanks, Adam. And welcome, everybody. And thank you so much, particularly for those of you joining us from the East Coast. It's an absolutely beautiful day out, and I know your time is valuable. So we're going to make this as valuable as possible. What we believe in is information that leads to action, education that leads to action. So we're going to present a lot of information. David and I had the great pleasure of presenting together last year in New York. We had a Peak Prosperity Summit there. Really learned that our views are very, very well meshed. So I'm going to take the baton here and just run through a few macro pieces of data. Then I'm going to hand it over to David, and he's going to pick up with his slides. Lots of data. Of course, data is great if it leads to action. So we're really looking for this to be actionable information. One other quick housekeeping thing. If you find that these windows that you've got here that display our faces that are in the way of the slides, you can move those around. So feel free to grab them. I've got mine in the lower left, just there's a handlebar at the top. So it's those can move them out of the way in case they're blocking anything for you. And great questions coming in. Already some I see here around the PPT and gold and silver and things like that. So let's get to it. Adam, if you could bring up that first slide, please. So this is Dangerous Markets. There's going to be three of us, here really presenting. David and I are going to be presenting data, and the New Harbor guys are going to be helping you understand, get some answers to some questions that you might have. So where do we start in this thing? Just go ahead and start on that second slide there. Our view at Peak Prosperity has been that it starts here. We went through this great crisis. Central banks printed like crazy. That's called balance sheet expansion. And world stocks and world bonds took off in concert with that. Very, very tight correlation, I think causation. And I'm dismissive enough of this. I think, David, don't let me put any words in your mouth, but I'm so dismissive of this. I've decided, next slide, Adam, that really we have to relabel our Fed officials. And I've relabeled them Larry, Moe, and Curly. They fit beautifully with the hairstyles even. And really, they've done things that are highly damaging to our future. And so I'm going to be a little dismissive of them today. Next slide. This is what we're seeing. Bubble one, first hump. Bubble two, we got a dromedary going. But what is that last thing when we look at the monthly chart of the S&P? We can see here just absolutely desperate attempts here to inflate. And they've got this inflation. The theory was this inflation was going to do awesome things. Well, we got a few jobs out of it, but we also got an incredible raging wealth inequality gap and income gap out of this. Next slide, Adam. So that's a fairly dangerous looking chart to me. We can express it another way, which is looking at the various bubbles relative, asset prices relative to GDP. The assets are the claims, but the GDP is the income in this story. So we've gotten really far away from things again. Third time's not the charm, I don't believe in this case. And that's the view that we're holding at Peak Prosperity. Next slide. By a lot of different measures, we're looking at the most expensive stock market ever. So here's a chart that's by John Hussman. I love this one. Looking at gross value add, corporate gross value add. So the corporations are the generators of the income in this story. Green line, red line, two different ways to express gross value add. Blue line, we're looking at the actual prices of equities relative to that. Again, to really believe in that chart being okay, you have to believe the four most dangerous words in investing. This time is different. Maybe it is, but if it's not, you really need to have a plan around that. So this chart scares me. It's just obviously, clearly bubble territory. Next one, Adam. This is the recovery that we're seeing since December. This is a chart of what are called it's a low volatility ETF. It's really tracking equities relative to volatility. Go to the next one, Adam, because this is so obscene, that chart. We have to put a protractor on there and discover that we have an 80-degree upslope in these stocks, and we're all supposed to believe that this is good. We're doing well here. This was a very desperate attempt. Of course, we had a little volatility in December, and the world central banks all freaked out. We had this Federal Reserve back up. Oh, no more rate cut, hikes. In fact, we might entertain the idea of a cut. No more balance sheet expansion. Maybe we'll take that off the table. But Japan, the European Central Bank, they all created the most aggressive liquidity conditions. This is the easiest financial conditions in any chart I've got right now. And of course, you get a chart that looks like that. Next one, Adam. And of course, what else do we have hitting new records? That slope starts and hits down there around October and starts taking off. These are sovereign bonds that have negative yields. Some corporates in there as well, but mostly sovereigns, where we have a new record of negative yield bonds. So remember, the prior chart we showed stocks taking off with an 80-degree slope. We have bonds taking off we're supposed to believe that both of these equity classes or asset classes are just tearing off to new highs. And of course, bonds have a negative correlation, have a negative inverse relationship to their price. So as the price goes up, yields go down. So here we're seeing new record, negative yield bonds. That just got hit last week. Next one, Adam. And European corporate issues. Look again in December, they just took off to the moon. So we have European corporates, stocks, U.S. stocks, world stocks, sovereign debt. Next one, Adam. It's just we're in a territory where everything financial is going up in price. And I love putting this chart up to just set some context because we've been here before. Bubbles are a very old phenomenon. There's only two things you need to have a bubble. You need a good story and you need lots of credit. So here's a famous bubble. This is the South Sea stock bubble, happened back there in the early 1700s. And what did you have? You had a great story. Oh, this company is going to just find gold all over the place or bring back riches from the New World. And you had the opening of lots and lots of new credit being available, and it created this bubble. And I put this chart up because it shows that this is one of the smartest people in all of history, Newton, right? Sir Isaac Newton developed calculus, right? Very intelligent gentleman. Got in, invest a little bit. He got out, quadrupled his money. And then he saw his friends getting rich. This was the hard part. He's going to parties and there are people asking, hey, Isaac, you got any of that South Sea stock? It became too much to bear. And so he re-entered with a lot and he exited broke. He lost 20,000 pounds getting caught up in a bubble. Very smart man, still lost a lot. And 20,000 pounds back then you could have bought countries with, right? It was a huge amount of money. So
Chris,
bubbles are really hard.
Chris, would you call this the law of financial gravity, perhaps?
I think, sure.
What goes up comes down, right?
Well, it always does. And that's because a bubble exists when asset prices rise beyond what incomes can sustain. Whether it was tulip bulbs or railroads or houses at one point recently, or now, you look at the things that I consider in bubble territory. These are a lot of IPOs being issued right now where their incomes can't possibly justify their current valuation. So one of those two things has to change. I think the law of financial gravity tends to win that story, right?
Yep.
Next slide, please. So just a little macro trouble to set it up, then I hand it right over to Dave. Next slide. First up, we're looking here at global trade. Global trade is now collapsing. It's at the worst levels and readings that we've seen since 2009. This is the backdrop for the China trade talks and for everything that's been going on, and for why the central banks freaked out and have just been creating easy financial conditions. So global trade really rocking downwards right now. Next slide. We've got as well economic growth trends all nosing over. And these include the idea that China's telling the truth about their economic growth. I think they've padded a few points onto their growth, but different story for a different day. So we are seeing the worst economic growth trend since when. Sometime back there, we'll call that 2008 and 9. Next slide. As well, in the United States, housing is now in a recession. Year-over-year comparisons to housing starts, to housing sales, all kinds of things. They're down. Hit advance one more, Adam. Auto sales in the United States, very weak. I think David's got some data around China and autos. So housing and autos presented, those are two of the three legs on the stool for the U.S. economy, very important ones. So those are also in not strong, robust territory right now. Next one, Adam. And as well, all of this is the backdrop happening when the world is the most indebted it's ever been. And this is just debt, right? This doesn't include unfunded liabilities, underfunded pensions, any of the entitlement programs, none of that stuff. Because then you multiply that $247 trillion number by a number like 4 or 6. It's the IOUs are much larger than the strict debt, but this is the most indebted the world's ever been. And, if we had more time or if there's interest later, there's an oil story. I won't get into this right now, but one thing that debt in indebted countries and individuals, companies hate is a rising input price that they can't control. And oil is one of those stories. So there's a big story there that is developing right now. Adam, so with that, if I have that right, I think that's just a quick macro sort of backdrop for you, David, and I'm going to hand it over to you now.
Alrighty. Okay, thank you, Chris, and I want to welcome everybody. We've got a lot to talk about here. Chris just went through the pessimistic part, so I'm going to lay out a number of macroeconomic charts and some charts on financial conditions, but it's all oriented to one specific thing, which is the heart of my presentation. It's the first chart. If Adam, you put that up. And I call it, the biggest risk that we have today is simply the length of the cycle that's underway. Do we have the charts up? For some reason, I'm not seeing them here.
I don't either. They're coming.
Yeah. Okay, here we go. Whoops. Got to back up a little bit there, Adam.
Yep.
Okay, we'll get this set up here in a second. Here we go. Well.
Got one, just you'll get it.
Sorry.
Yeah. And bear with us here. We're yeah. Okay. There we go. You got it.
Yeah. You got the first slide there. Yeah, sorry.
Adam, are we ready to go here now? Yeah.
I think we are.
All right. My point is, this is the single biggest risk we have in the entire investment situation today, and that is that we're now in month 118 of this expansion, so-called expansion, that began in June 2009, right after the Great Crisis. And the point about it is, one, recessions haven't been outlawed, and the deeper you get into a cycle, the longer the cycle goes. Obviously, looking at this chart, it goes all the way back to the 1850s. Business expansions end, you get a cycle, you get a recession, earnings fall dramatically, markets adjust, and the obvious point is that you need to be prepared, and the later it is in the cycle, the more inherent risk you have just from the calendar. Now, I'm not saying that cycles just die of old age, but at 118 months, we're 1 month from the longest one in history, which was 1991 to 2001, the great tech boom. We had a lot of headwinds in those days that we don't have now. We had a balanced budget at the end. The Fed had not yet, massively increased its balance sheet. Therefore, it had headroom to stimulate the economy when the recession did happen in March 2001. China was just finding its sea legs, ready to boom and pull the world economy along. It wasn't, as it is today, a $40 trillion, what I call red Ponzi, struggling just to keep its balance. Even Europe had just entered the single currency, and at least for a few years, they were going to have a boom as a result of credit expansion. So we've got today all kinds of headwinds that we will go through, but the important point about this chart is that the passage of time tends to accumulate risks. And we've gone through a policy, radical policy shift at both the central banking level and fiscal level that we've never been at before. And so therefore, this cycle, even though it's long, has not been benign. It has been 118 months of building up debt, and you'll see some charts on that in a moment. 118 months of practically zero real interest rates, which obviously have fueled a huge bubble on Wall Street and immense speculation that we've never seen before. 118 months in which the C-suites of corporate America spent a huge amount of time borrowing money that they then cycled back into Wall Street in the form of M&A deals and stock buybacks and leveraged recaps, all kinds of things that tended to boost risk asset prices, equity prices, but did not invest in productive assets and thereby lay the groundwork for down the road extending the cycle. So the point here is 118 months, we're near the record. Recessions haven't been outlawed, it's around the corner, and we've had a cycle that is the least benign expansion cycle in history, and that's evident here. If you look at this chart, the key point on this chart is the blue line at the bottom, the light blue line. What we're doing is tracking time and growth in the GDP. And this obviously is the weakest cycle that we've ever had, even though it's been long. If you look at the red line there, that's the cycle of the 1990s I've mentioned. At 118 months, GDP was up about 42%. If you look at the blue line, that's the great guns and butter expansion of the 1960s. By the time we reached near the end, GDP was up 52%. Where we are today in the cycle that we're in is less than 20% cumulative GDP expansion. So we've not only had, we've had a long expansion, but it's been half the size in terms of cumulative growth. And that's not because this cycle was a slow learner. That's because there are so many headwinds facing both the global and the domestic economy. We have so much debt. We have so much speculation in the financial system that it is much more difficult to grow at historic rates. And therefore, this is a warning sign. It is not a sign, as some on Wall Street are saying, that we got more time to run because we're only halfway to the goal. That's not how it works. What this suggests is that we have a cycle that's fraught with accumulated problems that create enormous risk as we get near the end. Now, if we go on to the next chart, it's just a reminder that one of the factors, the risk factors that is accumulated during this cycle of expansion is the totally abnormal experimental monetary policy that we've experienced, and it's really off the chart. I think this chart, this is just the Fed, but it shows you that it took about 100 years to get an 800 billion balance sheet right on the eve of the financial crisis in the gray area there in the middle. And in a little more than 4 years, that more than quadrupled to 3.6 trillion. And then by the time we got to the peak 2 years later, it was 4.5 trillion. The point is, a central bank cannot create its balance sheet at this rate, at this kind of steep incline, without sowing in the financial system all kinds of risks, excesses that we'll get to in a moment, that again are a reminder that we're late in the cycle and we're heavy with risks that have been accumulated along the way. Now, obviously, the central banks, even finally, the Fed decided in the next chart, if we look at it quickly here, that you can only go so far with balance sheet expansion. You can only keep the money market rate suppressed at practically zero and negative in real terms for so long, and you have to begin to normalize. And obviously, that's what's happening now in the pink area of this chart. And that means that we've really had a pivot here. Now, I know they said in the last couple of months that they're rethinking the normalization process, but the truth is, watch what they're doing and not what necessarily they're saying in the meeting minutes. They are still shrinking their balance sheet at 600 billion annual rate. That is removing liquidity from the bond pit, so to speak, from the financial markets. And the funds rate, as we'll see in a minute, is finally broken through the inflation line and has become real, has become positive in real terms. So we have a pivot after this long, crazy expansion and money pumping by the Fed. And again, that is coming at the very end of a long cycle that's freighted down with many of these excesses and problems we've been talking about. We go on to the next chart, and it's only a reminder that it isn't just a domestic issue here. It wasn't just the Fed. This is all the central banks of the world. It's quite astounding to look at this and realize that in 2003, the combined central banks of the world had a balance sheet of 4 trillion. It reached 25 trillion a few quarters ago. But even on a worldwide basis, led by the Fed, finally the pivot is beginning to occur, and all of the liquidity that was pouring into the financial system over this period of time, a decade and a half, is now reached a asymptote, let's say a peak. It's beginning to shrink, and again, that creates risks that we've never seen before. But you have to remember, as you look at this chart, when you create 21 trillion of central bank balance sheet asset purchases over this short a period of time, you fund it with liabilities that are plucked out of thin air, simply digital credit created by all the central banks led by the Fed. You're putting your thumb on the scale in a major way. In other words, that's what explains much of what Chris was showing in the charts he had, why we've had such tremendous inflation both in equity prices as well as bond prices over the last 10 or 15 years, but especially since the financial crisis in 2008. The reason for it is supply and demand. There's been a tremendous $21 trillion increase in demand for financial securities that really had nothing to do with GDP or income or production or savings out of real earned income. It was all created by the central banks. And again, that's what is so deceptive about looking at that long cycle that we started out with. It looks long, but it was so artificial and so distorted by what the central banks were doing. And here's the global picture. Now, if we go to the next one, this is just kind of a quick reminder of how big this was and how fast. This is from the peak or right below, before, the markets peaked in the fall of 2007. The big five central banks had a $5 trillion balance sheet. By the end of 2018, it was 20 trillion. Nothing like this has ever even been imagined in history before or thought about or argued for by any kind of serious economist. What's happened in the last decade is the central banks just stumbled into this one quarter, 1 month, 1 year at a time. And when you look at the box, you can see some crazy stuff. The Swiss National Bank balance sheet, for instance, grew by 800%. They're the biggest holder of Apple stock outside of a few large funds in the United States. And you can look at the other central banks. And again, you just see outlandish increases, all of which created distortions and massive inflation in the financial markets. Now, if we go ahead to the next slide, this is just a reminder. See, what I'm trying to say here is that as we moved along that 118 months of expansion, as weak as it was and as inconsistent as it was, we'd have a couple good quarters and then a couple quarters of slowdown. The point was, all the while this was happening, you had a devil's workshop going in the financial system as a result of these monetary and to a lesser degree fiscal policies. This is a big one right here. The blue bars on this chart are the inflation rate year over year over the last decade. The red bars are the money market rate as pegged by the Fed. And there's nothing like this in history where you have the money market rate this deep underwater in terms of inflation adjusted rates, negative for over 10 years. In fact, the real money market rate went negative in April 2008, and it didn't go positive again until you look at the far right-hand side of this chart, and you can see it right there where the cursor is going. Finally, in the last couple of months, we've had a money market rate slightly above the inflation rate. Why do I dwell on this? Because negative yields in the money market are the mother's milk of speculation. This is what players in the options market, this is what leverage speculators, carry trade speculators, as we call it, love, because they're leveraged 95%. The cost of their carry or funding is practically free. If you can find something that has a yield or going to appreciate for another week or two or month, a month or quarter or two, you can't find a better way to speculate than with this kind of cheap overnight money. So this is why the financial system is so loaded with danger and all kinds of risks that are kind of hidden at the moment, but when we hit the next recession, it'll all come to the surface. Go to the next chart, and this is a little digression, but our president is always talking about he's a low interest man, and he's been bashing the Fed for the last few months now, and even the other day said, let's get the money market rate, the funds rate down by 50 basis points, which would take it back underwater again, lower than inflation. But I say in part, his mentality on this, which is totally wrong and dangerous actually, comes from his history as a New York real estate speculator and developer. And this chart tells you all you need to know. If we go back to 1995, the condo prices in New York are up 260%. Take that as a proxy for development real estate. During the same period, inflation was only up cumulatively by 70%. But most importantly, the 10-year bond, which is kind of the benchmark for the cost of borrowed funds, the yield on that, therefore the carry cost, is down by 70% during that same period. So you can't think of anything better than having the asset go up by 260% and the carry cost, if you're a big leveraged developer at 70 or even 80% leverage, to have your cost of goods, so to speak, your production costs go down to 70%. So this made for a 15 times return on carried assets if you were in the development business. And so you understand why some people like low interest, artificially low rates, including the man in the Oval Office. It doesn't make them right. It only makes them dangerous because this is only one example of the kind of speculative excess that's been built into the system. And that is a danger at this late stage of the cycle. If we go to the next one quickly here, this is just a reminder that another reason the cycle has been weak, even if it's long, is that we've had a national LBO over the last 20 or 30 years. Historically, the debt to income or GDP ratio was about 1.5 times. That's all debt, public and private, business, household, finance. We reached a peak of 3.5 times on the eve of the crisis. Everybody said it was a wake-up call. We need to delever. Did we delever? Look at the blue. We didn't. Debt just kept growing, and we're still at a level that is 2 turns higher than it's been historically when we had stable growth in the 3 to 4% range and low inflation. Now, you put this in numbers, 2 extra turns sounds like, well, what does that mean? Well, on a $20 trillion economy, 2 extra turns of debt relative to the stable historic ratio that you see on the lower left-hand side here is 40 trillion. In other words, to think about why this cycle is in trouble, why the cumulative growth has been so weak, is because we're carrying around 40 trillion of excess debt relative to income compared to what was workable and proven historically. And by the way, that 1.48 ratio you see there in the left-hand side prevailed pretty much for 100 years after 1870 when modern industrial growth took off. So again, another reason why we're in trouble at 118 months is we've done nothing to fix or cure any of the problems that precipitated the last crisis in 2008. And that's the theme here all the way through all these slides. Nothing fixed, nothing healed. This wasn't a benign cycle at all. It was one that's generating ever more risks if you're in the financial market. Now let's go ahead.
David, before you move on, I just want to point out that little bump that where we see debt actually go backwards, that little bump almost destroyed the entire world's financial system, according to Hank Paulson, Mervyn King, all the big players at the time. So I just want to point out that we seem to have a system that's either growing its debts or it's threatening to collapse. And that's not really a great system to be locked into.
Very good point. If you can't take that little tiny speck of delevering, what's going to happen when we finally reach the limits of how much debt can be created? So let's go ahead. This is the world economy. You mentioned this, Chris. You don't have to dwell on this, but you mentioned the 250 trillion today. That's over on the right-hand side. You can look where we were at the turn of the century. It was 75 trillion. So we've had a 175 trillion growth in debt in the world. And this is all kinds of debt, government and private. Even since the eve of the crisis, if you look at the chart here, you can see we were at about 150 trillion. So the crisis was allegedly one of too much debt, too much leverage, too much speculation. The central banks of the world have basically conspired to foster the creation of another 100 trillion over the course of the 118 months that we've allegedly been recovering from this heart attack that occurred back in 2008. Moving on to the next chart, it's not, these are aggregates, but I think this one is even more telling. This is just the business sector of the U.S. economy, and we're including here both corporate and non-corporate. So you have, family businesses, proprietorships, unincorporated businesses, and so forth. Roughly at the turn of the century, there was 5 trillion of business debt in the United States. Now you can see on the chart here, we're a little above 15 trillion. The point is not only that we've grown the debt of the business sector by 10 trillion in hardly 2 decades, but almost all of it has been used for financial engineering, not public productive investment. In other words, if you trace it through and you look at how much M&A deals were done, you look at the stock buyback phenomena, you look at LBOs, leverage recaps, debt or dividend increases that were funded not out of earnings but out of cheap borrowings, which is one effect of what the central banks were doing. You've not only taken on 10 trillion that business now has to lug around going forward, but it was used for basically cycling back into Wall Street financial engineering, as I call it. That helped obviously boost the demand for junk bonds, for stock, for even investment-grade corporates. That all helped prices to rise, but it didn't help the Main Street economy to become more productive, more competitive, and have better growth capacity over time. If we take the next chart, this is on the household sector, and it's sort of the same thing. In other words, during the housing boom, that yellow line there's orange line, that's just almost vertical in terms of the amount of debt that was created on the household sector. From the time Greenspan stepped into office to the time of the crisis, which isn't that long, you went from about 3 trillion of household debt to 14 plus. It way outran the blue line here, which is the growth of wage and salary income, which is essentially what you have to support debt with and make the interest payments and amortization. The point is, to go to Chris's point, there was a slight deleveraging as we went through the housing collapse and the mortgage debacle, but it didn't take more than a couple years of low interest rates to get right back on the path of expansion. And today you can see from the orange line that household debt is 15.5 trillion. It's still 180% of wage and salary income compared to historically where it was about 80%. And you had a healthy balance between the two. So again, the business sector is weakened enormously with all that debt that we saw in the last chart. The household sector hasn't delevered either. And as a result, there is almost no capacity in our system on Main Street, business or households, to absorb a shock, any shocks or downturns which are bound to come. If we go to the next chart, I think we have just another view of a point that's important, and that is if you listen to the rhetoric coming from the White House, you almost have the idea, yeah, the cycle is really old, it's octogenarian even, but we got a real, new policy in place that is giving it a second lease on life, that somehow the economy, even at this late stage, calendar-wise, is booming again. That's just not true. We've had a couple of GDP quarters with a 3 in them. Those were pretty much due to inventory accumulation and all of this thrashing about with trade and the pull forward of imports, all of which distorted the numbers. So, basically what I do is I look at real final sales, which takes the inventory swings out of the GDP, and I look at a period of time, and frankly, I'm not trying to say Obama's better than Trump. I think they're both bad. But the point is there has been no acceleration of growth. There is no Trumpian boom, as I say here. If you look at real final sales average, it's been 2.55% in the first 9 quarters. Under Trump, it was 2.89%, slightly higher under the last quarters of Obama. What I'm saying is we're crawling towards the end of a business cycle, and whatever the rhetoric you hear out of the White House has nothing to do with it. Capitalism is trying to expand, and it's facing bigger and bigger headwinds from policy all around the world. If you look at jobs, it's the same thing. There's no boom, there's no acceleration. 28 months of BLS monthly reports, 202,000 new jobs per month average. That compares to the prior 28 months under Obama, 220. So you have to erase the idea that you hear on Bubble Vision every day and that you hear from the White House that this is the greatest economy ever, that we're booming again, that everything is taken off and old age doesn't matter. Not true. Just look at the bars on this chart and you can see pretty clearly that there is no Trumpian boom. It's a myth. And we're getting near the end of the road time-wise, as we can see. Now, if we look at the next chart, I think it's just another, what I want you to do here is look at the hooks on the far right-hand side of each of these measures. This is overall manufacturing output, and you can see it's now hooking down. The other two are business equipment and consumer goods. The point about this is that we are rolling over, I believe, after this long expansion, and yet during the entirety of this expansion, 118 months now, we have not yet regained the heights that we were at in the fall of 2007 at the peak before the big crash. Now, that means that we've had a whole business cycle going nowhere. In fact, we're still 2.5%, as you can see here, below where we were on the eve of the crisis. And the point is, if you listen to the pundits and if you watch Bubble Vision every day, every time one of these indicators here hooks up by a month or two on a seasonally adjusted, or as I say, maladjusted basis, they're saying the economy is perking up. But if you look at it in terms of perspective, because we've lost all perspective here, we have a tremendous, recency bias. But what I'm trying to show you here, right here, where I'm hitting the cursor, is that's what a real expansion looks like. In the 1990s, the tech boom, manufacturing output grew by 58% over the same period of time, 118 months, that we have actually shrunk by 2.5%. So there's something drastically wrong here. It's just another indicator why at 118 months you need to be worried about where we're going next. If we take the next chart, this is just another statement of the same thing. The black line down here is an index of total industrial production. We go way back to the turn of the century here. Okay, this is 2000. In the entire century to date, this is a fifth of a century. We're up by 14% only, whereas if we look at we look at imports, they're up 100%, and we look at household debt, it's up 140%. So the point about this is that the appearance of a recovery is basically been driven by borrowing and importing and not producing. And again, that's kind of a qualitative dimension of this so-called recovery that doesn't bode well for the future. Going to the next one, I think just another story. If you're looking for a boom in the late stages of this cycle due to whatever's happening in the White House, you can't find it here, and this is the heart of the matter. This is household real income year over year with the transfer payments excluded. Now, if this looks like a boom, you can see here, this is the final period of the Obama administration. Here's where we are today. There's no boom about it. We have an economy that's kind of limping forward towards the end of the cycle. The next chart, this is one that I like to focus on for this reason. You constantly hear the White House and the Donald saying, we got the lowest unemployment rate in 40 years, and we've never had an economy this strong. Well, he's talking about the bottom part of this chart. This is the civilian unemployment rate marching downhill, because that's what happens always and everywhere when you have a long cycle. The excess labor does get put to use, at least on a headcount basis. It's a poor way to measure labor utilization and the kind of economy we're in today, which is driven by hours and gigs and so forth. But my point is, it's not that you don't brag about a low unemployment rate in month 118 of an expansion that's on its last legs, because a reminder, here's the 1960s cycle, almost as long. Here's where someone was probably bragging, LBJ or the early days of Nixon. And then the recession hit, and here's where we're going to be. Here's where the Donald is going to be in a few months when the next recession hits the economy. So again, all the rhetoric is totally misleading. This chart here is a warning, a flashing yellow warning sign, maybe even red. It's nothing to brag about, but it's again an indicator of why we have so much risk build up. Now we go to the next one, and I think this is a point that I can make very quickly here, and that is the BLS numbers, the monthly job count, they're really not worth the powder to blow them to hell with. There's all kinds of manipulation, and there's all kinds of maladjustment in them that we won't go into today, but they're particularly bad, the monthly job numbers, particularly bad at the cyclical turning point. And I just went back to the 6 months when the bottom dropped out in September 2008 through the winter of 2009, when it really looked dark. And the point is, when we finally got all the revisions in 3 and 4 years later, the BLS was over-reporting the job count by 600,000 jobs on average a month, because it's got so many built-in formulas to its numbers that become inaccurate, like the birth-death model and the rest of it at cyclical turning points. So there's no reason to be optimistic about the 200,000 or 202,000 jobs a month that have been reported recently that I showed in an earlier chart, because I think if we are at a turning point, it looks more and more like that. The job count is being way over-reported, as you can see here, comparing the blue line bars initially reported with the orange bars that were finally locked in after a lot of revision and getting the real job counts out of the payroll tax data that are supplied by businesses. So moving on.
Hey, David, Adam, real quick, just checking in just to do a quick time check to see how much time we need left. This has been great so far. I just want to make sure we leave time for the folks to be able to ask questions of New Harbor as well. So how much time do you think we need?
We can move along here. This is only, this one quickly is to say the two lines in the bottom are an economy going nowhere. That's industrial production. The line on the top is the shale boom. That's output of oil and gas. That happened because of massive amounts of cheap debt. Chris talks about this a lot, that have been cycled by Wall Street into the shale patch. That isn't a sustainable direction or condition either. And it's just another example I'm trying to show here that, yes, we're 118 months out, but even the tepid recovery we've had has been supported by things like the shale boom. I'm all for shale. I'm all for technological advance. But when you put $300 or $400 billion worth of cheap debt into a sector that shouldn't be using debt at all, you're going to get a temporary boom that isn't sustainable. That's the point. Another feature of this recovery, the unsustainable aspects of it. Moving on to the next one. This is just a simple reminder of why we're at a danger point at 118 months. The gray bars are essentially periods of time in which the average GDP growth rate is marching downhill. The red line is the leverage ratio that we showed before, the U.S. economy. They go in opposite directions. And now here we are up at 3.5 times debt to GDP. Here we are with a trend growth rate of GDP since the prior peak of just 1.2%. This tells you all you need to know, that the economy is burdened, and therefore, as we near the end of this cycle, the risks that we face are really more than anything we've seen cyclically before. Going on to the next one, there's such recency bias. The headlines and the algos hype the last quarter, even though it's going to be revised and seasonally adjusted, and it's got all kinds of temporary factors in it. But what I like to do is look at the 10-year average real GDP growth rate, because that more or less filters out the cycle, smooths out the cycle, and obviously takes out all the short-run perturbations you get in the numbers that are reported, and there you see it. This is where we're going. We're now at 1.5%, the lowest 10-year growth rate. I don't even think it was this low actually during the Great Depression. Another reason why the 118 months isn't all it's cracked up to be. Going forward, we allegedly are having a CapEx boom from all of that, from that huge tax reduction to 21% for corporates and pass-through 20% deduction, all the rest of it. Actually, this year, revenue was reduced by about $200 billion just on the business tax side. My point here is that it has all gone into financial engineering, or 90% of it. There is no boom in investment at all. And so we're going to have the permanent debt. This tax cut was financed on Uncle Sam's credit card, but we're not going to have the asset base to support the debt going forward. This one actually is in real terms per capita, and you can see why 118 months isn't all it's cracked up to be. Back at the top of the last cycle, CapEx was averaging about $350 billion a month. In real terms, here we are now at $200 billion, and it's just another measure of where we stand. Now, moving forward, this is the same thing. You wouldn't know it, but if you look at the real measure of capital investment, which is after depreciation and amortization, after all, you churn that up during current year production. If you look at real CapEx after depreciation and amortization, we're at the same point today that we were at the turn of the century. Now, you can't grow an economy if you're not growing the productive asset base. This is plant, equipment, technology, software, all of it. And again, it's another reason why the economy looks as weak as it is. We'll quickly I don't even have to tell you about the federal debt. This is another thing that supported this cycle. We're now at $22 trillion. The truth of the matter is, objectively built in with the current tax law and current spending, on a willingness to take on entitlements, the warfare state budget booming because Trump thinks the bigger the better. You really have a national debt of $40 trillion. That's built in a decade from now. That's where that green arrow is heading. Again, it's another massive headwind against an aging cycle. This is, I think Chris touched on this. This is just another version of, everything bubble. But the point is, if you look at the asset household net worth as a percent of GDP, we're at an all-time high, far higher than anything we've ever seen in history. And that, again, isn't sustainable because GDP is just another measure of income. And if you don't have income underneath asset prices, sooner or later, you're going to have the big correction. You're going to have the reset. And the higher up you are on this relationship between income and asset values, the greater the risk, obviously. And that's where we stand today. Moving to the next one. Another sign of the blow off top. This is just right here. All you have to do is focus on that one. That's the percentage of IPOs of companies that have no profits. Okay, we're at 80%. If you go back prior to what I call the Greenspan era of bubble finance, started here back in '87, tended to be historically about 20%. We're now about 80%. And that's about where we were in 2000 when the great dot-com bubble collapsed.
What could go wrong?
The next one, this is another measure of how overvalued things are. Again, this is the market cap relative to national income or GDP. We're at a point today much higher than we were back at the time of prior to the great financial crisis, and even higher than we were at the peak prior to the dot-com bubble. Next one, the point on this one is, yes, these asset prices, stock prices are in the stratosphere, but if you listen to the talking heads, you would say, well, that's because profits are booming. Now I say, take a look at this orange line right here, because this is pre-tax profits in the entire economy, whether you're a public company or private, and it doesn't have the distortion in it of the big tax cut, rate cut that we had recently. And you can see basically we're at the same point of pre-tax profits that we were way back in 2012. And if you go back to the pre-crisis peak, we're only up by 1.23% per annum over the last 12 years. And so the point is that isn't booming profits. That's in nominal terms. And in real terms, profits haven't grown at all. Just another indicator of how out of whack we are in terms of valuations of risk assets. Same thing here. I just think this number is so fantastic. It's worth focusing on. If we go back to the Greenspan's arrival right here, we can see since then, household assets, this is stock, bonds, real estate, cash balances, and so forth, are up $102 trillion from 20 to 121 or 2, whereas the GDP is up only $15.5 trillion during the same long 30-year period. Now, you can't go on indefinitely with the asset value growing 6.5 times the growth of income. It just doesn't work. It's not sustainable. It defies both common sense and the laws of finance. It's just another reason why we're in an extremely risky point today. Chris mentioned, now we've had all this asset inflation. If it was going to everybody, it might be one thing. Everybody could spend their assets and we could go on for a few years, but it hasn't. If you go back to Greenspan's time, again, the top 1% had about 33% of the net worth, and the bottom 90% had 33%. I'm not complaining about that. That's the way capitalism works. But since we've been in the era of money pumping, bubble finance, the top 1% has gone to 40%, the bottom 90% has gone down to 20%. That isn't a sustainable equation. You don't even have to think about that very long to see what that implies, again, for the sustainability of an old, weak cycle that we're in today. One or two more here, and I think we've covered, Chris hit the, I'll just skip on this. My point is we're not going to be bailed out by the red Bonzi. We know that now as a result of the trade war that's getting red hot, but it's still worth looking at these when you get a chance. My last point is, if you go to the last hope that pigs will fly is not an investment strategy. And it usually ends up, as the next chart shows, with the mullets going over the cliff. So this is hopefully a little bit of context, a little bit of background of why I think we're at such a dangerous point in the cycle and why you don't want to be collateral damage as we move into the next phase of things.
All right. Well, David, thank you so much. Quite a tour de force. And there's, the big pieces of this has really been about leverage. And what we've done is we've managed to put a lot more debt in. I think the central banks are really about putting a lot of debt in. I want to just, one quick point, because I know you're in politics for a long time, obviously. Janet Yellen's been out saying that the Fed is non-political. But when I see that 1% move up its wealth curve, to me, the ultimate act of politics is taking from one group and handing to another group. Hasn't the Fed really been like a deeply political organization in many respects?
Of course they have. And, that's a complete myth. The Fed is the most powerful agency in the entire domestic economy. The chairman of the Fed has as much power, if not more, than the president. Everything they do, because it's artificial. I mean, they're trying to falsify financial prices. That's what yield suppression is all about. That's what pegging the funds rate is all about. That's what, buying bonds at $80 billion a month like they were doing, QE was all about. So all of this is political. They're trying to use what is inherently a political agency to alter the outcomes that would otherwise occur on a free market. And they can say, well, it's not Republican or Democrat. Okay, doesn't matter. It is political, it is artificial, and it doesn't benefit the citizenry in a uniform or consistent way. It benefits the rich. I mean, that's what happens. We saw it in the chart. When you inflate financial assets and you deflate Main Street, and this, we didn't even get into this, but half of this financial engineering is undermining the productive capacity and competitive efficiency of Main Street. So what the Fed is doing is basically undermining Main Street and inflating Wall Street. And, that's about as political as it gets.
I agree. So the question comes up, and we've had a lot of questions on the side which relate to, what do you do about this? And oh my gosh, couldn't the Fed just keep doing this forever and ever? And we know that we still have to play the game, right? We still have money, we still have to manage it, we still have to do all that. So I want to bring in my good friends at New Harbor Financial, and John and Mike, if you want to just click on here. New Harbor Financial is a group that Adam and I ran into a while ago, and we've been working with them for a long time. They're great people. So some of these questions that you guys have been asking over on the side, which is, hey, what do you think about the PPT? Is gold manipulated? These are all fair and open questions. These are a couple of deeply experienced financial professionals who will not look at you like a dog listening to white noise when you ask those questions, because we live in obviously a very politicized Fed, a very manipulated environment. There's nothing more manipulative than just throwing tons and tons of money into the market, calling it QE or balance sheet expansion. These things all have their effects. So Mike and John, why don't you introduce yourselves real quick and bring you into the conversation, because we got a bunch of questions to go through.
Yeah, good morning. I'm John here, and thank you for having us this afternoon here where we are, morning or evening where your viewers might be. Real pleasure to be here, and happy to answer some questions.
And I guess I'll just add to that, we're the guys that have the unenviable job of how to manage assets, with this type of backdrop. We're in the biggest bubble, in our opinion, the world has ever seen. We're registered investment advisors, and we manage money hands-on for folks. So we like to think that we're a little different. We're non-traditional in our thinking. We look at the real data, and we make hard decisions. It hasn't been easy to do that in this bubble that seemingly never ends. But we're all about protecting assets and taking advantage of what we think will be much better prices down the road.
Well, good. And so can you just give us just a snapshot of your investment philosophy, just so people understand how you've been approaching this?
Yeah, happy to do that, Chris. So, first off, I guess describe ourselves as, demanding to see data, demanding to see evidence. Mike and I, for better or worse, we're engineers by academic training, so we come at this profession with a pretty discerning eye for show me the proof. We warmly greet positive, optimistic data and news when we see it, but we're also very open-eyed and practical about, some of the concerning data that we see, many of which you touched upon today. And, we're just we're just thrilled to be in the esteemed company of folks like Chris and Adam and David, because we are in the midst of a narrative machine that has never been seen of this magnitude. And to have folks like you pointing out really not opinions but observable data that can go back a century or more and study really makes our difficult jobs that much easier, because we can point to highly credible third-party folks who dissect the data in a way that allows us to then have a conversation about truth and action based on truth, not narrative, with our clients. So it's very, very important. It really underlies what we do.
Great. Well, a heart of the question that I think is on everybody's mind, David Summers captured it very well. What is to prevent the Fed from just expanding its balance sheet? Again, I inserted one word in there. I assume expanding belonged in there. But this is really so, David and for Mike and John, it's been a long, frustrating ride. Obviously, the Fed is scared to death to allow any sort of corrections to happen. So what is to prevent them from just carrying on, and how should somebody position themselves given that?
I guess I'll take a shot at that, Chris. It's difficult. It's difficult at time. Timing is almost impossible. Almost everyone, it seems, the investing community seems to think that cycles have been outlawed, that there's no cycle and there's no seasons anymore, that there's no corrections, that the central bankers have finally got it right. We look at the data, and valuations are extremely high. The way that we think they should be measured, the cyclically adjusted price earnings ratio is up in the mid-30s, 30-something, 35 times earnings. If you adjust it for profit margins like people like John Hussman does, we're up in the mid-40s. Investments in the S&P 500 at these levels will almost certainly yield negative, zero, or even negative returns over the next decade or so. And frankly, we expect at some point along the way there's going to be very large pullbacks in the S&P, probably greater than 50 or even 60 or 70%. So what's to keep the central bank from going on with it forever? Frankly, it's a pretty delicate, difficult system to understand, a multivariable system. In our view, there's a couple things that probably will stop it from going on forever. Political pressure. There's increasing political pressure against what you talked about earlier, Chris. Wealth disparity. It's getting pretty bad. It's pretty bad so that I think it's like 8 or 10 people own half of the wealth in the world at this point. It used to be 100 a bunch of years ago. It's one of the things you often talk about. I don't think that's going to go on forever. You see more and more political pressure swinging towards more socialistic ideas. I think there's going to be, at some point, it's going to be really difficult to keep doing the reverse Robin Hood thing like you talked about.
I'll just add one thing there. The game theory, psychological torture that underlies questions like that. I guess a couple points I'd like to emphasize is, we don't have to look back too far to see that the almighty Fed and central banks are not infallible, not infinitely capable of controlling things. All we need to do is look at the last two bubble poppings, the subprime crisis and the tech bubble, and you can go back and look in the throes of those declines, both of which exceeded 50% stock market declines. The Federal Reserve was aggressively cutting interest rates. So when it decides to turn and the blind faith in the policymakers runs on thin ice, it's almost unstoppable. And this time is not different. It may be extended and pretended longer, but we think the same kind of sudden psyche change as to the infinite powers of central banks to control things will run out of steam real quick. And now, again, our job is to at least educate our clients as to what kind of bets they are making on that kind of game theory, and not have some delusions that this is a market that is fairly or even undervalued and reflective in any way whatsoever the fundamentals and likely to give a any kind of sustainable financial return from these levels. We think there's going to be great opportunities ahead, but the key is being very conservative in the meantime.
Yeah, guys. So given the concerns about all the the money printing that the central banks have been engaged in over the past decade. And David showed a lot of charts that showed how tremendous the growth in the overall money supply out there has been. I know that you guys recommend that your clients maintain some sort of position in precious metals, really as a hedge against the currency crisis, because that's really what, runaway money printing, that's the ultimate datum on that trajectory. Can you talk a little bit about how, what you recommend people look at in your own portfolio for clients, the role that precious metals or precious metals mining companies may play, but just give people a sense of how you look at that potential risk of a currency crisis in the future and how people can defend against it. Oh, and one sec too, David, Chris and I are keeping our audio muted. We're getting a little bit of feedback when we're hearing the New Harbor guys talk. So if you can look on the bottom left of your screen, there should be a mute option. Try that and we'll see if that helps at all.
Okay. Well, that's a great question, Adam, and I think it was a common thread in some of the questions in the chat board there. So look, we do think precious metals and real assets in general are a great hedge against the distortions that central banks have created in fiat monetary systems. We believe that you can kind of look at it in two ways, from an investment merit standpoint, but also as an insurance policy. So because of the experiment, let me state what I think is hopefully obvious. We don't see any kind of silver bullet, excuse the pun, to hedge against the full menu of risks that we see out there. There's economic risk, there's geopolitical risk. So there is no silver bullet. And this whole idea that our industry is based on of, don't worry, just diversify your assets has really been corrupted because, asset classes, especially financial assets, have become so correlated with one another. They've all been inflated with reckless abandon by these interest rate suppression and money printing tactics that there's little place to hide. Bonds aren't the safe haven that they used to be relative to stocks and vice versa. So we do believe there's a great insurance policy need for assets and tools outside of the monetary system. And that's where we think precious metals can play a very important role. We do think that most folks, depending on their situation, again, this is not generalized financial advice, we'd be happy to consult with folks one-to-one if they have an interest. But we think that some physical metals, preferably stored outside, kind of the kind of central system, is a great insurance policy hedge against things like currency collapse, rampant inflation. But beside that, we also think there's a great compelling investment case to be made with low interest rates and low real rates, as well as the record undervaluation of things like gold mining stocks relative to other financial stocks. We think there's a great upside investment story for precious metal investments, and particularly precious metal mining company stocks.
Great. And in terms of the precious metal mining stocks, they've been it's been kind of a widow-making industry over the past several years. What thoughts do you have on the outlook for that industry right now?
Well, the industry is severely undervalued relative to the price of gold. There's been a lot of value destruction in that industry. We'll admit that there has been some attention by CEOs and other executives in that industry, and they've over leveraged a little bit. So there's a little bit of value destruction that might quantify it and even justify some of the weakness in prices, but it's just so drastically undervalued relative to the price of gold. I mean, if you look at the ratio of gold to the actual index, or the inverse of that, the inverse to the price of gold. I mean, it's just at levels that have never before been seen, and it's been sustained there for a bunch of years. We're bullish on the precious metals and other tangible assets, as John just talked about, because of the fact that central bankers have targeted financialized assets with their expansionary money printing. And the things that you can do to get outside of that system will probably protect you. And so we like gold and silver and other tangibles, and for that reason, the miners, we think is a good way to, to play that. It's a leveraged bet on gold and silver, but they're just drastically undervalued relative to the fundamental price themselves.
And I will add that industry as a whole has done a tremendous job over the last few years cleaning up their balance sheets, getting much more disciplined about jettisoning marginal projects, I should say. So they unlike, for example, the shale industry, have done a really good job cleaning up their balance sheets. So they're not quite as impaired from they've done a lot of the hard work of cleaning up their balance sheet and are much more investable than, say, they were 5-7 years ago.
Mm-hmm.
Okay. And so obviously if precious metal prices begin to start increasing from here, the profitability of the industry should be better than it would have been a couple of years ago, given that kind of winnowing out of the weaker players. Yeah,
and even if you look again, the relative undervaluation of those companies relative to the price of gold, the simple takeaway is you can see the price of gold stay flat. Not that we suspect it will be, but if it did, there's still some upside in those stocks just to get back to the historical norms of values relative to the price of the metal, because they are so depressed relative to the price of the metal.
And just to follow up on this, so one of the reasons why we have referred so many people to you over the years is your focus on risk mitigation and how you guys use hedging as an opportunity to minimize downside risk in the portfolio. And certainly with miners, when you've got an asset class that's that volatile, minimizing risk becomes even more important. Can you just talk a little bit about the role that hedging plays in the portfolio, and maybe even sort of use some examples on the miners and on how you're using it there?
Sure. John and I, we're engineers by training. We're technically minded, and we really get into the nitty gritty of portfolio management. And one thing we like to use that we think is underused in our industry are options. We use options to hedge quite a bit. We'll sometimes, for your example, you asked about how we would use them with miners. Over the last couple of years, on an on and off basis, we have added protected put options to the miner exposure that we have. Just to use an example, if you take a look at one exchange traded fund, which is ticker symbol GDX, which is VanEck, I believe it is, gold miners. They're at around 20 or 21 right now if you look at the price of that ETF. We presently have put options in the high teens, in the 18, 19, 20 area, going out a few months. We sometimes pay for put options by offsetting sales with call options on that index or other indexes or other positions we hold in the portfolio. But we think options are drastically underappreciated, and it allows us to hold a position that we know is fundamentally undervalued and hated, I might add. Sentiment has never been more sour than in that industry. Now, those two things, valuation and sentiment, if they're extreme over the long term, you're probably going to do well in that position as long as you can hold on to it. So fundamentally, we hold a position size that we know that we can live with and that our clients can live with, and we apply put options so that we can withstand the storm. I mean, if GDX were to fall to 10 overnight, we would have a rock bottom price of maybe 18 or 19, depending upon the put option that we have, and it would allow us to hold on to that because we wouldn't want to sell it if that happened.
Yeah. Just a quick, lesson for folks who might not be familiar with options and put options in particular. The simple analogy of how they work is very, very similar to how an insurance policy on your house or your car works. You have an asset that would be costly to repair if there were a unexpected event, and for a small insurance premium, you can get insurance to protect that asset from financial harm. And that's really how put options work in practice.
Okay. And to the greater question of looking at the charts that David and Chris put up, showing how extremely overvalued the markets were and overleveraged and whatnot, and huge risk of a big reset coming. Should the reset happen, how are you positioning right now for that?
Yeah, well, it starts with how we are positioned right now, and exactly, we have much of our clients' assets, we think with good supported reason, in very safe assets, even a very substantial portion in cash-like instruments. Now I say cash-like because the devil's in the details there. Most bank deposits right now are paying almost 0%, which is unconscionable because those very banks are by virtue of the way that the central bank has quote unquote raised interest rates. They've been getting a handout in the form of what's called interest on excess reserves from the Fed at the expense of U.S. taxpayers, and basically pocketing the difference between that 2+% interest payment they're getting paid by the Fed and not sharing with their depositors. So, if folks out there share, our concerns and are holding a bunch of money in safe things like cash, you should at the very least be putting it in things like short-term treasury bills, which are yielding, 3-month treasury bills are 2.3, 2.4%, or in that ballpark. So be very, demanding of what you get on your cash, because there are options out there available, like we use, treasury bills and so forth. And there's no need to go out long. So for example, as of yesterday, 10-year U.S. Treasury bonds were yielding about 2.39%. That's essentially exactly what 3-month Treasury bills are yielding. Right. So no benefit whatsoever of going out in term on safe bonds. Keep things really, really short. And what that represents is dry powder that can be deployed when the broader financial masses are, running for the hills, watching their portfolios evaporate before their eyes. That's the great time to be buying and putting things to work at much more compelling valuations.
Yeah, I might add, Adam, we into the audience, we're 0% exposed to the stock market right now. We have a very high allocation to treasury bills. And one of the first things we do when we talk to somebody new or somebody asks our opinions, we take a look at their risk exposure. And we're reducing their exposure to equities drastically. We know that it feels like this ride's going to go on forever. We guarantee it won't go on forever, but it feels like it will. And most people that we talk to, even if they're very conservative, are 80+% exposed to the stock market, usually concentrated in U.S. domestic stocks, which are amongst the most overvalued of them all. And so the first thing we're doing is getting them, or even just telling them, to reduce risk dramatically. And the common response that we get is, what are we going to do with the money? They literally think they have to be invested all the time. So we're telling them to drastically reduce risk, to reduce their equity exposure to less than 30%, preferably, maybe even to 0%. We're not recommending outright shorting. We haven't been outright shorting for our clients, but we've been essentially flat the stock market for quite a while, frankly. Timing on this thing has been pretty difficult. So once they reduce risk dramatically, we'll tell them to take a look at reducing debt, get some exposure to precious metals, think about other investments in tangible assets like rental properties, farmland, etc. And those things aren't right for everybody. And so for excess cash, we would park it in treasury bills, earning around 2.2%, like John said, and wait for the inevitable correction. And the response when we talk about corrections from folks is that, well, the market always comes right back. Well, it did come back in 1999 and 00 after a greater than 50% drop. And that was because of cutting interest rates and creating yet another bubble, the housing bubble that ran up into 07, 08. And then that collapsed. The S&P dropped 60+%. And then, of course, we reinflated that into the everything bubble. So we've had 2 V-shaped recoveries over the last 20 years. And we think we're in the third and largest bubble ever right now. And this one, we think, can't guarantee it, but we think it's going to be much more of an L-shaped drop. It's not going to be a V right back. It's going to be a drop, probably greater than 50, 60%. I mean, a run-of-the-mill pullback would pull us back 65%. And if it's an L-shaped drop over the next 5 or 10 years, it's going to hurt a lot of people, but not expected. That's what we're trying to do.
Yeah, I would like to comment on that, because I think that's the key point. If you go back to my 118 months and you look forward, you've got tremendous risk of 2 types, and you have almost no reward, in my view, because actually the market closed Friday not much higher than it was in January 2018. That was 15 months ago. So that's the kind of reward you're getting. You're getting a lot of grinding, but what's out in front of you? One is the recession that will come, and when recessions come, especially in markets that are this overvalued and bubble-ridden, the drop is 40 to 50%. But secondly, this time it will, I'm not sure, but I'm pretty confident it will be an L, because the authorities are out of dry powder. Remember, and that's a big point. When Bernanke, when Greenspan reflated the housing bubble, he started at 6 1/4 in December 2000 and marched it downhill for 3 years to 1%. And it was month after month, meeting after meeting, more stimulus, more ease. In 2008, Bernanke started at 5.25%, and he marched it downhill essentially to zero. Well, today we're at 2.4. There's not very far to go. And today we have a bloated balance sheet that even the Fed heads are somewhat afraid of, still at 4 trillion. And so therefore, they're not going to come up with the kind of massive reflationary policy that caused the market to bounce back in a V form. So therefore, if you're taking a risk for almost nothing so that you can end up 40% lower and then dwell there for the next 3, 5, or 8 years, which is really what's likely to happen in an L-shaped recovery, the risk reward actually is much worse today than it would look like at the end of the 2000 cycle or at the end of the 2008 cycle. There was still room for a V. I think now we've got an embedded L, and that's all the more reason why you need a totally different portfolio strategy. One that can, protect your wealth and generate some modest return over an extended period of time as we go through, well, let's just call it the great reckoning that lies ahead.
I'd like to really emphasize the great point that David just made. We can look at some of the data series that David and Chris shared in their slides.
David, can you mute real quickly?
Yeah.
Can you hear me okay?
Yeah, I was asking David to mute his microphone.
Okay. I'm sorry. So you can look at those data series and actually look at, historically speaking, what they portended in terms of prospective returns in the stock market, for example, say over the next decade. And there's actually some data series out there that are very highly statistically correlated, over 90%, predictive value in terms of subsequent returns. So you can look at some of those series and, come with a conclusion that's supported by history that, right now, a passive investment in the S&P 500, you'd be lucky over the next decade to break even. And maybe a bonus is you make 1% annually, including dividends. So the conservatism that we preach is not born in the belief that a crash is necessary, needs to be imminent, even though it's certainly possible and the conditions are permissive of that. But it's simply that there isn't enough upside that, as David pointed, to justify that risk. You can get 2.3% in a 3-month treasury bill. Why on earth would you be putting yourself at largely exposed to a stock market that's likely to deliver less than that over the next decade and be subject to a 50 to 70% decline in the intervening period? That may sound crazy, but the historical data supports exactly that kind of scenario.
And we're at the point, it feels like, it seems, a peak psychological discomfort. We talk to new people all the time and existing clients, and there's a lot of distress out there. And in our opinion, the Fed is engaging in psychological warfare to an extent to get people to feel so darn uncomfortable with being in anything other than stocks or other risky assets, could be real estate or even art, it seems. If you're in cash, you feel uncomfortable, and people just want to be in it. They want to be in the pool. And one of the big values I think that we're bringing to the table to the people that we talk to these days is being somewhat of a buffer between them and their psychology. Because mathematically, this thing has got to reset to some degree. And we want to do our best to help people avoid that pain and then maybe even set themselves up for good solid returns going forward for maybe even the rest of their lives. And the whole name of the game is to keep as much as possible and have some assets to deploy at valuations that are likely to be better going forward.
And that's where we really value the approach you guys take versus the traditional broker out there who keeps their clients fully invested 100% of the time at all times, right? And I know that it's very hard in this market to tell people sometimes, look, cash sometimes or T-bills can be the right place to be, even though they're totally unsexy. It was really helpful that Chris put up the Isaac Newton chart, right? Because it shows you, that at those peaks, it gets really hard to resist the siren song of getting back in when people, are still getting rich and everyone's saying, the party's going to go on forever. Mm-hmm. John, you mentioned that those data series that correlate very tightly that show that, future returns for the next decade are practically going to be zero, right? And I know John Hussman's one of the guys that puts those together. He's got that great saying, right, that bubble markets force you to make a choice.
Yeah.
to look like an idiot now or look like an idiot later, right?
Absolutely.
And sadly, we have to look like idiots now to be safe. Right? Everyone else is out there on the risk curve, but we'll definitely look like geniuses. So, when this correction does hit. One thing I just want to mention for folks watching, I don't know if we were clear about it, but we've worked out an opportunity here through David with the folks from New Harbor to be able to offer you guys free portfolio consultations with John and Mike, the two partners there. If that's something you're interested in, I have posted a link on how you can schedule one of those free consultations. It only takes you about 30 seconds to schedule. I'm going to post it again right here. I'm doing all this in the chat window. So if you don't have the chat window open, please open it for two reasons. One, we're putting some links to resources there, but also I want you to be able to ask questions. I see some people asking questions in the Q&A system. I am looking at those, but if folks can work in the chat window itself, that'll be really helpful. One other thing too is you guys have been mentioning certain resources like purchasing precious metals or purchasing T-bills or investing potentially in other hard assets like real estate. We have primers that we've written at Peak Prosperity on kind of the basics of how to do each of those. Those are all free. I've been posting those in the chat window as well. So folks, if you have an interest in any one of those, feel free to read those free materials whenever you want. All right, let's see, guys. Another question here. This one will be for you, David and Chris, and really for everybody. But have we ignored the possibility that the Fed will continue to buy everything, but especially T-bonds, to ECB levels? Really just kind of doubling down and going whole hog. Were that to happen, what are the implications? I'm going to shoehorn in another question that was asked earlier too, which was, what's to say that buybacks aren't going to continue to drive the market for much longer than we think they can?
Okay, those are good questions. Let me start, though. We had the slide of Newton from 1721 or 22, whenever it was. I just want to remind everyone, I've been using the theme, don't become collateral damage. And I want to remind everyone, you don't have to go back 3 centuries to see what happens, how quickly you can become collateral damage. Go back to March 28th, 2000, at the peak of the dot-com bubble. The NASDAQ 100 had gone from 800 to 4,700 in less than 3.5, 4 years. And here's the key point. In 14 trading days from that actual literal peak, March 28th, the market was the NASDAQ 100 was down to 3,300. It dropped by 35% in 14 trading days. Now that's that's gravity, that's financial gravity falling hard. And I would argue that this bubble has been inflated to such a degree, and it's been extended for such a long period of time. And the amount of central bank artificial liquidity that's been pumped into the market is so great that we're at great risk of another 14 days, of the apple falling hard. And so it's time to get prepared, even if you give up a few percentage points of the last gasp of the market going forward. Now, on the Fed, can they resort to another round of QE? Oh, sure, they can do anything. But I think they have a credibility problem, twofold. One, if the market starts to correct, they're going to be massively attacked by Donald Trump, by the guy in the Oval Office in a way never before. And I think they're going to be reluctant to buckle over. I mean, I don't believe in the sanctity of the Fed and the independence and all that. In fact, I would abolish most of the Fed, at least the Open Market Committee, if I could. But the practical matter is they are going to resist a pivot to outright easing. It's one thing to say normalization is on hold, even though you're actually draining $50 billion out of the bond market every month. That's what they're doing right now. It's quite another to pivot in the opposite direction and begin the bond buying again. That's the first point. The second point is they said all along that this was a one-time expedient. We're facing a 100-year, a 500-year kind of flood, and so we're going to do something that's totally radical, and that's what QE was. And if they now try to institutionalize QE and say it's what we're going to do, as a matter of course, I think there's going to be a great credibility problem because it's going to underscore that QE failed. And if it failed the first time, as it was described as a last resort radical expedient, if it failed, I'm not sure that they're going to be able to easily justify a massive swing back into QE.
Great point, David. Hey guys, just a quick note here. I've been posting links for the past 10 minutes and realized I was sending them only to the panelists and not to the attendees. So attendees, you're now getting them. Sorry, as I mentioned, we're using this platform for the first time. And of course, there's a little bit of hiccups here that we're figuring out. But you guys should now all have those links. Someone else asked, can we get a hand of the charts that David and Chris showed throughout the webinar as well? The answer is yes. Just as a reminder, at the end of the webinar, a few hours after it ends, we'll send all of you via email a link to a replay video of the webinar so you can watch the whole webinar again. But we'll also send links to the individual presentations that Chris and David showed. And I will also provide links to how to set up a consultation with New Harbor, as well as some of the resources that I've mentioned. So you'll get all of that in the email that's going to be coming later on today. Sorry to interrupt. I think, Chris, did you have something?
Sure. You will never find anybody more helpful than Adam. He's just a wonderful business partner. He will get you everything you need. Absolutely.
Thanks.
So let me combine a couple of things. One, corporate buybacks are a symptom of a disease, and that disease has been financialization. Hey, if you can use money to make money, why take all this risk of hiring people and building property, plant, and equipment and trying to gauge markets and all of that? So that's part one. And that leads to this idea that my belief is that when the next downturn comes, it's going to be very fast and furious. As David was talking about these big, 14%, 14 trading day, 35% drops. The reason that we're very suspicious of these markets right now is, one, mostly high frequency trading computers. 80 to 90% of all quote volume is just algorithms looking for the next best thing. And then what we have is the idea, though, that these things can turn very quickly because business cycles are not the same thing as credit cycles. In a business cycle, you're starting to see reduced foot traffic. You're starting to read the signs that maybe, there's a recession coming. With a credit cycle, all of a sudden, people in the boardroom say, I'm not buying my shares back tonight. We're going to stop borrowing money tonight. These are very, very rapid decisions that can make the average downturn in a credit cycle so much more vicious than an average business cycle. This was the prime crime of the Federal Reserve under Alan Greenspan in 1994, saying, hey, we think we can get rid of this business cycle thing. And he gave us that first credit cycle, which blew up in 98, then again in 2000. Then we had another one in 2007. And here we are. These are repeated serial mistakes. They've been a little bit higher and a little bit more vicious each and every round. We think we're in a third round of that. Listen, we might be wrong, but we're not confused. We've got all this data behind it. And that's why we think that, the data-driven approach that you have with Mike and John at New Harbor and the way New Harbor approaches it, very important. But whatever you do, please be sure to understand, the context of these markets. These aren't your daddy's markets. They're built differently. A lot of, they move very aggressively, very rapidly. They're global. Who remembers that Apple reported subpar first quarter results, and the next thing you saw was the New Zealand currency getting hammered against the Japanese yen crosspair? What's this all about? Well, that's the market we live in. They're all interlinked, and it's all, very sophisticated, speculative, highly leveraged trading algorithms that are doing funny things. Well, it's been a war on reality through all of that. Fundamentals haven't mattered as much. If we had the time, I would tell you all the fundamental reasons I love silver at this point in time, hammered down by speculators who've decided this is a better price for silver than a higher price. But when you look at the fundamentals of being in a 10-year structural shortfall, and when you look at the miners themselves actually now at below their cost of production, you understand this is a good fundamental place to be. So, without putting words in everybody's mouths who's presented here today or talked, this is just a time where we think the pendulum is now swinging back away from highly leveraged speculative trades that are all going to unwind in relatively spectacular fashion, even if we can't predict the individual moves, and we're going to move back towards fundamentals. And our view is you have to be positioned for that before it starts to unfold. You have to have your plan in place, and that includes your buy list. What are you going to move back into? At what prices? What are you saving that cash up for? These are all the questions that we think you really need to have in place right now, which is why we wanted to bring you this information today, have you talking to the guys at New Harbor to develop your plan. Even just knowing what that plan is, even if you're executing that plan, that's fantastic, but you got to have that plan, and it's got to be put in place before the excrement hits the fan, because we think that's going to be very fast moving, very hard to make decisions around, and it's going to be a tricky environment to try and find your footing in. So do it first. And, we have all this data to support our position. Love to talk with anybody about it more fully. We'll have the slides available. Anybody wants to download them, they'll be available as well. So that's sort of, my view of why we think you really need to be positioned before things start moving quickly. Because 35% in 14 days, David, that sounds kind of hard to figure out how to move through.
Yep. In New Harbor, to Chris's point there of, putting your plan together now, having a sense of how you're going to react once prices have been lowered to something that's more sane. Let's assume that, the volatility that we're beginning to see over these past week and a half or so, is the beginning of the big drop. And I'm not saying it is, but let's just assume that it is for a moment. What are some of the sectors that you're looking at that you'd love to move into, more your portfolio into once better valuations are there? And what are some of the metrics that you're going to use to determine, when the entry point is right?
Yeah. So Adam, I'd like to answer that, but quickly, I'd like to just make a point that, we spend a lot of our time counseling clients and prospective clients about what to do with their money other than to give it to us. So this gets to the heart of, how do you respond to this, kind of corrupted market, which, lends itself to, well, can't they keep doing this forever? Well, you have to realize that the financial assets and publicly traded markets aren't the only area that you should be attending to. You should be attending to, this likely will cause disruptions of various sorts in the economy and whatnot. Invest in yourself, get skill sets in place that maybe give you greater job stability if there's a protracted recession. Get your debt in order. Look at your budgeting. Mike and I are both certified financial planners, so we spend a lot of time talking about things other than the hands-on assets that we manage for clients. But insofar as the pool of money that we do look after in their financial assets, we use a data-driven approach to look at things like which sectors are obviously fundamentally becoming more attractive values, but we look at technical indicators that tell us, what is the market saying are the areas that are starting to look like gems among the ashes in a pullback. So we'll look at things like relative strength, the leaders and laggards, and importantly, our hedging tools are a great way to kind of allow us to kind of toe dip back into markets, even while they might be in free fall, because the option tools that we use can take out the sting of being wrong in terms of perfect timing. Case in point, we largely were out of the markets in 2008, but started getting reinvested in late 2008, and we did so what in hindsight could be measured as a few months too early. But because we had hedges in place, the sting of that being early wasn't nearly as impactful, negatively impactful as it would have been. But Mike, I'm sure you can add to kind of the metrics we use. And
we'll be looking at relative strength, and we'll need a pretty large pullback in the market, and then we'll start putting on positions in sectors that we like. I mean, right now, if we had to choose sectors, we would look at ones that are severely undervalued, like mining shares we already talked about, but also the whole commodity complex is just drastically undervalued relative to financial assets. I mean, soybeans just hit multi-year lows the other day. Not really easy for individuals to buy direct commodities, but there are ETFs out there that own things like DBA, which owns a handful of different commodities. We're not in that position. We wouldn't be buying it here today, but it's one of the things we would consider probably after a further washout. Another example, oil and gas stocks are really undervalued relative to the S&P. We had a position in those late last year. We got out of it with a small profit before they fell even further. But we'll be looking to continue to maybe add to that position or add it back in, certainly with a further pullback in the S&P. Now, one more thing, emerging markets around the world are better valued, have much better valuations than domestic markets. There's ETFs like EEM and other things that invest in emerging markets. These markets are a lot lower valued than U.S. markets. So we actually have a position in emerging markets presently, but all markets are so highly correlated that we actually don't. We know that, and we feel that the S&P is going to have a large pullback, and so we're not fooling ourselves. We know that emerging markets will also be correlated to that. And so we have our position in emerging markets offset by a short or negative position in the U.S. market. So about a 10% position in emerging markets and a minus 10% position in U.S. markets. So, that's our way of being in that and still hedging out that risk. We'll very likely close that short position in a significant retreat, and which will automatically get us into a 10% long position in emerging markets. And we would certainly increase that position quite a bit from there when the time is right. But those are a couple sectors that we like right off the bat here, but there's no telling what's going to look most attractive after a protracted bear market. And we've got tools to take a look at that, basically seeing who's starting to jump first, what sectors are breaking out first. It will be joining those trends.
Okay, great. One of the questions that we just got here is sort of about international markets. We've had some questions about both China and Europe. Do you guys, and I'd love to get Chris and David's feedback on this too, as those markets continue to stumble, one person here specifically asks about a failure of the euro, but do you expect, more money to be flooding into the U.S. as a safe haven? And then at what point, does the U.S.'s own baggage begin to make the U.S., less of a safe place to put your money? I guess it's a question sort of about global capital flows. What are you guys watching, and what do you think the likeliest implications are going forward?
Or do you want me to address that?
For us, or is that?
Yeah, let's get David first.
Okay.
Well, look, I think the point that was being made a moment ago is very important, that when the real crunch comes and we get the big reset and the market goes into a free fall, well, they say, every correlations go to 1.0, and that is really true, especially when you're this extended, when the bubble has lasted this long, when the complacency has got as deep and as great as it is today. The shock of a market that goes into free fall will basically cause people to sell everything. And so therefore, you really, unless we're in short-term treasury bills and cash instruments, which is what I'm in, there isn't much to invest in at the moment. It's not that you can't do your homework and get prepared for when you're on the other side of the correction, but I think that big correction has to come first. And in the international environment, in the global picture, it's going to start, in my view, in the red Ponzi. Do not believe that China is the greatest thing since sliced bread. It's a worse story than Japan was in 1989, and we know where that went. You have never seen so much borrowing so fast. If you go to 1995, China had $500 billion of debt. It's 40 trillion today, at least the part they can count, and it's probably a lot more. Now, you can't raise your debt in an economy that doesn't really even have, at that point, any free market institutions or contracts or bankruptcy traditions or laws. You can't take that kind of post-Maoist economic breakdown and increase the debt by 80x in less than 2 decades and think you ended up with a solid, sustainable economy. It may look like our economy or Western economies, and they may report all kinds of stats that sound like it, but it's not. It is a Ponzi, and it will come unraveled, and when it does, the whole thing is going to collapse big time, and that's why I call it the red swan. I'm not sure. There will not be a black swan this time. It's either going to be orange after the man in the corner office there, or it's going to be red after his Emperor Xi over in the other corner office in Beijing. one of those two places. So, my bottom line is this is not a bubble. This is not a risk in one country. This has been done in lockstep globally by all the central banks in a convoy following the lead of the Fed, in part because it seemed to work in the short run, and in part because they had to, or their currencies would have appreciated dramatically, their export industries would have been hammered, and they would have had domestic turmoil and political difficulty. So every central bank in the world marched along with the Fed. You saw my chart, 4 trillion to 25 trillion. Everybody's in the same boat, and I think the most extended part of that boat is the red Ponzi. That's where it's really going to come apart big time first.
All right. Well, great answer, and really underscores the whole reason why we're doing the webinar today, which is to take action now so that you're not collateral damage when that Ponzi collapse. With that, we've gone a little bit over the intended time for this, but we wanted to give people a little bit extra here. David, want to thank you both for the excellent analysis and for giving us a chance to speak with your audience, and hopefully the connections here with New Harbor is a really added value for folks who are trying to figure out how to be positioned right now. As mentioned, everybody who's registered for this webinar will receive a copy of the replay video in a few hours. That'll have all the registration links in there, as well as the link to set up the consultation with New Harbor. If you're interested, as we mentioned, that's totally free. And given that David's lined all this up for his audience with us, we'll make sure that you get a consultation with the lead partners, Mike and John. So you're getting the absolute white glove treatment from the firm. David, thank you so much. David, Chris, anything to say in closing here?
I think we've covered it pretty well. Now's the time for action. I think, as I said before, the risk reward has never been this clear. The reward is tiny and the risk is immense and growing by the day. And so that means that you really got to think, where you're going forward with your financial assets.
Yeah, my final words would echo those, and as well, I would add one thing. You can look back and discover that Da Vinci had figured out for himself the basic processes of geology and how old the Earth was. And this is at a time when the church had a very different view of how old the Earth was, and so our advice is just trust yourself. Like, if this doesn't look right, if it doesn't smell right, just add up the data. Whatever you do, trust yourself, because again, you don't want to be Isaac Newton in this story. You don't want to be the person who's jumping in right at the end or clinging to a bubble. This is a massive bubble that we're in. That's what all the data tells us. If you disagree, that's fine. But if you agree, you really need to do something about that condition and take action. And the time for action is before anything hits the fan. So with that, thank you so much for your time today. I really appreciate everybody coming to spend this moment on a beautiful Saturday with us here. So with that, thank you very much. And hopefully we can do this again sometime.
Great. Thanks, folks. Yeah, we're getting a lot of really nice positive feedback from folks saying they got a lot of value out of it. Fantastic presentation. One of the only places to get this type of messaging and information. We are happy to bring this to you. We know that we just scratched the surface, literally, of the iceberg, both in terms of the data that Chris and David can go through, or in terms of the personal questions that Mike and John can address. We'll be happy to do this again in the future. If you want to have repeat webinars like this, just let David know through his website, and we can certainly produce another one of these for you on whatever topic you want, whenever you like, in a way that works well for David. So with that, guys from New Harbor, David, Chris, thank you all for your time. Everybody who attended, thank you so much. And keep your eye out for those resource links and the welcome video in about 4 or 5 hours, folks. Thank you.
Good day, everybody.
Thank you.